Marilyn, since late August, especially since early November, bonds have been a horrible place to be. You maintain that they're really not that bad if you know how to get into them and maneuver.
That's exactly right. You don't throw the baby out with the bathwater. It's been the 10 to 30 year area of the bond market that has gotten bludgeoned. And I predicted this. I wrote a book that's coming out at the end of March called Surviving the Bond Bear Market, Bondland's Nuclear Winter. I think we have started a bear market in bonds. I think that we are going to see more selling than most baby boomers have ever experienced since they've had skin in the bond market game. But that doesn't mean you totally throw it out as an asset class. It means you have to be smart. There's two ways to make money in the bond market. You take interest rate risk or credit risk. And with the economy bumping along and doing better, with cash balances on corporate balance sheets doing so swell, I think you are better off taking credit risk and buying 3-year, 4-year, 5-year bonds, clocking that 4 to 5.5% yield. Some of them are even 6.5% yield, and keeping your arms around the credit quality of the company that's the issuer. And that's the way you will start to earn income and let the bond market bear continue, because it's going to, and inflation is going to be a big problem in the next, well, it is now, but it's even going to get worse in the next couple of years.
It seems like people are more worried now about municipalities than they are about corporations.
That's been the disaster area.
So where do you go in muni bonds? I mean,
Well,
is it attractive enough? Are the yields high enough yet, like in Illinois and places like that looked awful, to lure people in?
Let's rewind. The bond sell-off in the municipal bond space has been a wave, November, December, January, and continuation in February. It's all about credit quality. It's all about the fear that the once safe haven munis are no longer safe. You can buy pre-refunded bonds due in 1 year and 2 year, you the retail investor, and use it as a money market place for your cash, and earn 1% due in 2012 and 1.5, 1 3/4 in 2013. And you individuals are sitting in the driver's seat because it's the odd lots, the 25s, the 35s. That's where the yield is, and that's significantly better than earning a 1 basis point or 2 basis point tax-free yield in New York, California, or your national money market fund. Do you just absolutely stay away from munis totally? The answer is no. You can buy good quality munis that have nothing to do with unfunded pension liabilities, nothing to do with deficit spending like we have seen in New York, Illinois, California. You can buy water and sewer bonds. You can buy airport revenue bonds. Do 2, 3, and 4 years. Stay in front of the maturity curve. Don't go out yet and buy 20 and 35-year bonds because you think that this is the buying opportunity of the decade. This is just the first wave of selling, and we've got many more ahead of us.
Not so fast, my friend, right?
Right.
So how about corporates? Give me a name of a company or an issue that you really like.
My favorite is something I wrote about in my most recent Forbes magazine column, and that's CIT Finance. This is a company that went into Chapter 11 bankruptcy during the credit crisis, came out, and guess who's their CEO? John Thain, the same guy that sat in front of CNBC saying we've taken all of our write-offs in the prime subprime slime Merrill Lynch deal. Well, there's nothing better than having a CEO who wants redemption, and that's what he's doing. You haven't heard from him, you haven't seen his face anyplace. He is turning around, has turned around CIT, paid down their high coupon debt, has the best balance sheet of any finance company that I have looked at in the last year, and they have bonds, 7% bonds due 2014, 15, 16, and 17, and they started to call them. So the CIT story will be a very short-lived story, but in the meantime, you can buy a bond that's on 30-day call yielding about a 2.35, and if it goes to maturity, 5.5%. That's money in my estimate.